Hello and welcome to another edition of Brazil This Week from the Brazilian Report. My name is Euan Marshall, Deputy Editor of the Brazilian Report, and this week we're discussing Brazil's central bank and its benchmark interest rates, its latest decision, what that means, what's happening in the future, and why do we care? And to discuss all of this, I'm delighted to be joined by Mário Sérgio Lima, the Senior Analyst at Medley Advisors. Mário Sérgio, great to have you back.
Well, thanks, Euan. Thanks the Brazilian Report for the opportunity. I hope I can help us understand and navigate the intricacies of monetary policy in this discussion.
Yeah, and I mean we've got a short space of time to do it, but hopefully we'll educate a few people here, including myself. But yeah, so yesterday we had the latest monetary policy committee meeting, and they announced that Brazil's interest rates would not be changed from the current level of 13.75%. The statement that they brought out after that was, a lot of people were saying it was still quite hawkish, as recent statements have been, but maybe not quite as hawkish as it was before. Do you share that view? What did you make of the whole thing?
I share that view. We can like, if we're going to subtleties, it was, in my opinion, almost as hawkish as the past, even if they are removing some of the parts that were like almost anachronical, in my opinion. Until May, they kept a sentence in the statement that they have been sharing since September, after they stopped increasing rates, basically saying that they would raise again if situation merited. In my opinion, and this is something that I even voiced to policymakers, is that once you put in a statement that, because it seems like pretty obvious, if inflation is doing bad and it's worse than expected, it's higher than expected, you increase rates. So, I mean, that seems obvious. So when you put that in a statement, it is what we call a forward guidance, which being basically like you're trying to tell the market that this is the imminent step. And everybody knew that this step wasn't imminent, and it was just a matter of when would they be able to cut. So I think by removing this is less hawkish in comparison, but it is also more. We have been having a faster disinflation than they expected. Inflation expectations are improving. So at the same time, for the new landscape that we are in right now, I think it's just as hawkish, because it's just like, by comparison, it's a situation where you could merit a more dovish, which is the opposite approach to monetary policy.
Excellent. And so, like, when do you think then that we might be expecting a rate cut?
Mhm. I think that I expect it. My forecast and Medley is for a September cut. Although, if I were a central bank board member, I would start with a residual cut of 25 basis points in this next meeting in August. And why do? But I am basing on what my recent talks with policymakers going into this meeting. As you know, they have a period in which they can meet market people before the silent period, in which they are not allowed to have any private meeting. So I had some meetings there before that time. And also the statement had words like, we should tread with careful parsimony. We should be cautious. So I mean, those words tend to indicate that they do not foresee a cut starting in August meeting, even if it's a residual cut. But what I think it was clever of them is that they never fully closed the door. So basically, they're saying, we are looking into the inflationary dynamics, so we will be data dependent, and we will be looking into some aspects that, if those aspects move to the way that we like, we can start cutting. which are inflation expectations, meaning what the market expects that inflation will be in the next years. They will be looking at economic slack, which basically is like the type of when you just if you increase rates, it's like you're if you increase rates, if you have a more tightened monetary policy, you increase the slack. I mean, it would affect like job markets. People would start, unemployment would raise. So I mean, they would be looking at that, and the kind of neutral rates, which is basically where you have rates that do not that hold inflation, but they do not force unemployment to increase. So they would be looking at that. They would also be looking into the disinflation and the core inflation, which is running a little higher than the headline inflation. Which so the core is like a specific set of products in which you remove some parts, some that are more volatile, so and tend to be less affected by monetary policy. So they, even if they have to look into headline inflation for their targets, they look very closely to core, so as to how much the type of monetary policy, the tightening, or if they say the easing, is acting on that number of inflation.
And so, like, just taking a little bit of a step back to, like, for people who may not be like super accustomed with all this discussion of like interest rates, benchmark interest rates, and what the central bank's job is in all this. Can you just a quick, very brief explainer of just like what is a benchmark interest rate?
Okay.
And why would you raise or decrease it?
Well, I mean, the benchmark interest rate, it's like you could simplify it by saying it's like the zero risk rate, which is basically what it's a measure, it's a measurement in which like all of the operations that are doing in open markets, they have this. So it's like the central bank acts to have those rates running into that level. So for why does it matter for the economy as a whole? Basically, when you have when you have a level of the benchmark rate, the banks are like they grab money at market into with that cost. And when they are going to do their lending, they will put some what we call like the spread, which is basically what it's like, basically where how they can the profit added into a loan. So that's the benchmark rate is like the minimum. So it's like you can say, okay, there isn't it possible to have lower rates than the benchmark? It's possible, but you have to do some sort of government plan in which you subsidize those loans, so you compensate to it. So that's that's why it's important. And as higher as a rate as the key rate is, it becomes costlier to get loans. It's costlier for companies. It's costlier for families to get loans. So the debt becomes it's like you're making it costly to the cost of the money becomes like higher. So that would reduce demand. By reducing demand, you would expect that inflation would follow suit. So you raise rates and expect that there's a lagged effect. What they say is like you raise rates and then there's a moment in which the market and the economy is accommodating to this new level, in which now, so if you're reducing demand, you're actually inflation tends to go down. I mean, this is like I try to simplify as much. And why does it matter? And why is that becomes important for the countries that when you have this kind of you're hurting demand in a sense by increasing rates, you may have some other effects which are negative for businesses. Some businesses can be more indebted, so they have like a debt into some level, and then their debt is costlier. Also, you can bring people out of businesses. You can reduce employment levels, because then businesses being with less resources, they need to cut costs, and they can cut costs on labor, which is a very important part into inflationary pressures. So all in all, the higher rates are not good for anybody in the economy, but they are, sometimes you need to do this because an inflation out of control creates even more imbalances in the economy moving into a longer period.
Right. No, excellent. Really great explainer. Thanks for that. Just before we continue, I'd just like to make a brief shout out for the Brazilian Report, which is the news outlet that powers these videos and our Explaining Brazil podcast, and also all of our news posted on that website as well. And it's a subscriber-based website, so we do rely on your subscriptions, so please do check out Brazilian.report/subscribe. We've got a bunch of different payment options, payment tiers, membership tiers, which gives you access to different benefits, and you're definitely going to find one that kind of fits your budget. So please do check us out. And also, if you are already a subscriber and you want to support us a little bit further, or if you want a different way to support us, you can also check out our page on Buy Me a Coffee, which is where you can donate us, like a few coffees every month, or whenever you like to send a few donations our way, because journalism requires caffeine usually. So yeah, definitely check out buymeacoffee.com/Brazilian Report, and there we also have a kind of membership tier within Buy Me a Coffee, where you donate a regular amount every month, and you will get access to kind of special newsletters and all these other little behind the scenes goodies. So definitely check that out. Or you can also check out the QR code that is there on the screen. And just so coming back to our discussion then, Mário Sérgio, on these on the interest rates and how this has become something which is, I mean, certainly in my time in Brazil, I've never seen the discussion be so ubiquitous around the country, as in there's people on the streets talking about the interest rates has got to go down, or they don't have to go down. Suddenly everyone seems to have a really strong opinion on what the interest rate should be, and I doubt many of them would be able to explain why it should be higher or why it should be lower. We've seen this really become a political issue, frankly, with the Lula government kind of claiming that the central bank is halting Brazil's progress by holding interest rates up, and the central bank kind of in response digging its heels in and not wanting to reduce rates as soon as maybe it could. But like beyond all of this back and forth, beyond all of this political comings and goings, do you think that interest rates should be lower? I mean, I'm not sure what your take on that would be.
Yes, I think that yesterday's decision was the right call. But like I said, I think they should start easing in August. It's not a 25 basis point cut wouldn't do much in terms of economic activity. And like I said, there is a lag. The lag you can count at least like 6 to 9 months in which the monetary policy can start having the direct effect, either increasing rates or cutting rates. So you have this lagged period. So 25 basis points wouldn't do much, but it would do wonders in terms of signaling that we are now in a place that we can cut. We can start because the economy is having a better result than originally expected, okay? But a lot of that comes from agriculture, which is not something that the rate wouldn't affect that performance as much. So activity, it's probably going to be way less potent moving forward, way weaker. So you're starting to put the rates in a position, because we now, with this inflation, now we have a somewhat high, very high real rate. What is the real rate? Is like the difference between the rate, the benchmark rate, and the CPI levels. So I mean, as soon as you have that very high, you're really putting a lot of strain in the economy. So by start easing, you would start showing some goodwill in terms of, okay, we are having some good news on the fiscal front. We are having this inflation. Global prices are kind of like helping us, so we can move forward, and we can start cutting, and this will give up some new life to the economy. And also, when you're thinking about investors, there's like a common misconception in which you raise rates and you're like doling out money to people that we call like rentistas, like the people that are living on those rates,
Yeah.
I mean, of course that happens, this creates an opportunity for some investments, especially fixed income investments. But when you look at the full market of investments, a lower rate would also boost equities markets, so like the share markets, which tend to have a better. It's better for the economy that the stock indexes are going higher than the fixed incomes, because you're actually stimulating the productive side of the economy. So I mean, when rates are starting to come down, you will see people move to equities investment, and it's like it really opens up. A lot of companies will feel more empowered to get new loans or sell bonds and market. So, and also there's another thing that people do not remember usually, is that as high as when the rates are too high, a good chunk of the Brazil's public debt is nominated on the benchmark interest rate. So if it's too high, you're actually like, you're saying, so like it's almost like a catch-22. The central bank says, oh, we need fiscal policy to be in check for the monetary policy to start easing, because if not, inflation will go up and then everything's going to go south. So at the same time, when they raise a lot of rates, they worsen the fiscal outlook because the debt becomes more costlier. So it's like a catch-22,
Yeah, you can't really win.
So that's why, I mean, the government has is using this. There is a strawman argument, I think. Campos Neto, the central bank president, he was way too close to comfort from the previous administration. For instance, he voted in the election using the Brazil national team jersey, which was like almost the uniform of the Bolsonaro supporters last year. So it's not good, that. So it's like he's a perfect strawman in which he's overseeing the monetary policy, the tight monetary policy, and you have, and he's also like connected to the former president. So you can say that he's sabotaging the government, which I don't think it's true, but that's political rhetoric. It is what it is. People will use this, like you mentioned. Everybody's discussing rates because, like I said, nobody likes higher rates. It's bad for the economy as a whole.
Right. Yeah. No, totally. And it's interesting you talk about Roberto Campos Neto being a straw man. There's literally has been protests in Brasilia using kind of Roberto Campos Neto as like an effigy, like in burning him. So I don't know if there was any straw inside there, but definitely that analogy works. That analogy definitely works. And what's interesting, I think, is that in years gone by, maybe there wouldn't be a discussion like this, like between the government and the central bank, because I mean now what we have is the Brazil's monetary authority is what we would call independent. And so, like, can you explain a little bit, like what that means?
I mean, technically they're not independent; they're autonomous, but legally
Autonomous.
autonomous. But it's just it works out pretty much the same. I mean, independence they would have like their own budget.
Right.
They could have control of their budget. They do not have, but they are free to do the policy as they find it fit. And then the government cannot they cannot remove a central bank president just because. You need to have a reason, like a palpable reason. And even so, you need to go through a lengthy process in which you would recommend the removal of either the central bank president or one of its board members to the Senate, and then the Senate needs to vote. So it was easier before. I mean, you can just like remove. And also you have what we which is basically the main thing of the Brazil independence rule, if you may, is you have non-coincidental mandates. So they have like a set mandate of 4 years, every board member and the president, the central bank, but they are not non-coincidental with the presidential elections. So, I mean, you have nine members at the board. So you have each year you will see two members being replaced. Either they can be replaced, or if they just served one term, they can be selected to another term. Two members each year, and then the president in the middle, 2 years after the election, then the president, and Lula can finally name his chosen one for the central bank head position.
So like it's staggered, right? So Lola, for example, wins the election in 2022, and then you have two central bank directors in 2023, and then 2024. So it's all
so I mean, by the time that Lula actually manages to have a central bank president, he will have like the majority of the nominees.
Yeah.
So because he has already named two board members, they are due to be argued at Senate next week, which I mean, I think it's going to be like a cakewalk. They will be argued and they will be approved by the Senate's Economic Committee, and then by the floor. So they will be approved, and they will take seat before the August central bank meeting. That's almost a given. Next year, they will nominate two more, and the end of next year also Campos Neto. So Campos Neto's term ends next year. So by then, like you already have four, you have five with the president, so you could score a majority. Which I mean, if we're just saying that those are technical decisions, it doesn't matter if who has a majority there. But I mean, it does like give the central bank, give the institution of the central bank a more sturdy look than in the previous time, because you just cannot like, it's not just they're not part of the government. If you remember, the central bank president was a minister. He had the ministry. He had the level of minister before. So now what you're saying is like, okay, this is they are not so that I mean, institutionally that's an advance, and which puts Brazil way closer to what happens almost everywhere else. Almost every major, important, relevant central bank has its independence from the political It's like you're shielding them from political interference.
Yeah, well, like a member of the cabinet can be, can be fired any day of the week, really, and sometimes that does happen depending on the government in Brazil. But when you turn the central bank into something which isn't a cabinet ministry, it's a lot harder, as you explained, and that gives them maybe a little bit more room to be autonomous, to be independent, as we said. And just another thing that we get asked a few times by listeners, readers, and viewers, because a lot of our viewers are in the United States, and just maybe what are the kind of the differences or the similarities between Brazil's central bank and the kind of the equivalent in the US, which is the Federal Reserve. Yeah.
Well, in terms of this independence, I mean, it's important to highlight that we just got the central bank autonomy. So Lula, and you can give him that, he had a central bank president that he left. He allowed the guy to be as autonomous as he could in setting policy. If you remember, even when Meirelles rose rates, people from PT like trashed Meirelles, and he stayed there. So if giving a vote of confidence to this government, Lula in his previous administration, he allowed those guys to have the operational autonomy, which it's what they had. But now, like I said, now with the formal legal autonomy, it creates some challenges because, and I think Lula actually sees Campos Neto as too close to the previous administration, which was, in hindsight, a mistake from Campos Neto. But we're learning to have this kind of independence, which the Fed has. It's something that is so prevalent there that Biden has put Powell, who was named by Donald Trump. He gave another term to Powell. So I mean, in a sense, it's like there's an institutional advantage for the Fed comparatively. Brazil, as the Fed, like we have a resemblance of a dual mandate, which is not the same as the Fed. The Fed does have a dual mandate in which they have to look not only for inflation, they need to meet inflation targets, but they also have a target for unemployment. So even if you really ask for anybody there, they would much rather sacrifice the unemployment to getting a target. But anyway, they have a dual mandate. Brazil, you have like a subsidiary mandate in which technically you should be looking at employment and activity level, but it's not really enforceable in Brazil. So there's also a difference. And there's some differences in terms of the people that the board, that the people that actually take to vote. In Brazil, you have 8 nominated sub-governors, if you may, some directors, sub-governors, which basically each of them have they run some areas of the central bank. For instance, you have like the economic policy director who runs the whole part of the inflation, the inflation models there, the part. So it's a very key member of that group. You have also the monetary policy director who looks at open market trading on the central bank. But you also have like the supervision director, who is important in terms of actually the part of the central bank that looks into financial stability. He's the guy responsible for a lot of that, but it's not like he's not really planning and setting monetary policy. So you have like they're divided by areas of how they operate there. While in the Fed, you have like in the board, and you also have like with power of votes, there's a lot of district Feds. So you have like the Fed in New York, the Fed in Richmond. So there's like they round, like for some years, so the guy from one of those Feds will be taking a vote. On other years, they change, but they also have like these regional Federal Reserves, and those guys actually are pretty powerful in their own district there. And they take part they may take part in the board decisions too. So there are some differences between the Fed and Brazil's central bank, but one could also be say that Brazil's supervision is so much so good that we are not really under the risk of a financial crisis that we are seeing, for instance, now in the U.S. We already have like 3 banks going under in this year. So I mean, the Brazilian banks, of course, like smaller banks become liquidated. They have to close operation, but it doesn't really create a huge systemic problem in Brazil. Which I mean, you could say that the Brazil Central Bank is doing something right in the technical staff in their area.
Okay, excellent. Thanks, Mário Sérgio. That was really insightful, really hopefully quite educational for a lot of our viewers. Certainly was for me. And just before we go, just like to make another quick shout out for the Brazilian Report, which is the journalistic engine behind these videos and our Explaining Brazil podcast, all that sort of stuff. So please check out the Brazilian.report/subscribe, because we are a subscription only website, and we rely on your subscriptions to keep us going and allow us to cover Brazil and Latin America. Check that out. We've got lots of different membership tiers there, and certainly something that will fit your budget. And as well, if you want to give us a bit of extra support, please do check out our page on Buy Me a Coffee, which is buymeacoffee.com/Brazilian Report. There's also the little QR code in the corner of your screen at the moment. That's where you can donate coffees to us, which we need. I'm going to have one myself in the next 5 minutes, I think. And just kind of to support our work for people who are subscribers already, or maybe don't want to be subscribers just now but want to find a different way to support us. And also there we have a kind of a membership system where you can donate as a fixed amount for every month, and you get access to a bunch of little perks as a member. You get a shout out on our Explaining Brazil podcast, which is certainly the best perk of all. But also a lot of different exclusive newsletters and behind the scenes content. There's a lot of kind of fun stuff in there to get your teeth into. And so, yeah, just like to say, Mário Sérgio, thanks a lot for joining us today, for helping me, for helping our viewers. And I'm sure that we will be discussing this again in the future, because this interest rate discussion is certainly not over, is it?
No. Thanks a lot for having me here, and I hope we're going to be discussing monetary policy more technical and less a political drama. Maybe the rates are going their way and being lower rates. It's going to be good for everybody.
Okay, excellent. Okay, well, thanks a lot to Mário Sérgio, and thanks to you for watching. And this is another edition of Brazil This Week. My name's Euan Marshall, Deputy Editor of the Brazilian Report, and we will see you again next week. Bye-bye.